Hello traders and investors, welcome back to the Trend Trader channel. In today's video, I'll be giving you an update on the 10,000 Rand stock trading challenge. Earlier this year, I mentioned that in 2023, we will be taking the challenge again, but in this case, we will not be trading 10,000 Rand, we'll just be trading our full account and we will normalize it to 10,000 Rand so that we can give you updates based on the 10,000 Rand value. Before we continue, I would like to ask those who haven't subscribed to please consider subscribing. And if you find value in this video, please smash the like button. If you have any questions regarding this 10,000 Rand stock trading challenge or just any questions in general, feel free to write your questions in the comment section. We respond to all the questions that we are getting. So just a brief background, we know that we trade stocks. We're in the stock market investing our money, but our approach in the stock market is by using a technical analysis and taking opportunities depending on what we see. The opportunities that we take are based purely on price action. We are not taking position because we believe in the prospect of a particular business or company. For example, we know some people are excited about Renergen starting to operate the helium plant. So that is not the kind of information that will make us want to take a position in any particular company. Whenever we take a position, it is because when we look at the price action or the chart of that particular company, we see an asymmetric risk to reward. This basically means that first we need to understand how much risk we are going to take in that position and what is the potential benefit that we can derive from that particular position. So if we see that the risk to reward ratio is asymmetric, meaning that for every 1 Rand that we are risking, we may have a chance to maybe make at least 2 Rands, then that is the kind of risk that we are willing to take in the market. So that is what we talk about when we speak of asymmetric risk to reward. There are so many different approaches that you can use in the stock market. There is no one right approach. There's just the approach that you are comfortable with. Other people are comfortable with value investing. We are comfortable with the use of technical analysis. I mentioned that we are using EasyEquities as our broker. You don't necessarily have to use EasyEquities. There are limitations to EasyEquities. For example, our approach, we use take profit. Sometimes we use stop loss, we use buy stop orders. And these tools are only available for the top 100 companies in the JSE. That's if you are using EasyEquities. If you are using a different broker, for example, Absa or PSG, you're always going to have the stop loss, take profit, buy stop order, all those kinds of things. So for this particular video, keep in mind that we are using EasyEquities. So there are some limitations that we are aware of. It's something that you should be aware of if you are an EasyEquities user. For charting, that is looking at price action, we are using a TradingView. TradingView is just a platform where you can look at the charts. You can register an account for free so that you can save the template that you are using. We do have a video where we are describing how to set up a free TradingView account, how to add stocks that you want to be the stocks that you want to be on your watch list, how to use some indicators. Every time when we post a chart, we are using TradingView. We are not affiliated with TradingView. We are not sponsored by TradingView. It is just a platform that we are comfortable with. If you are not comfortable with TradingView, you can also use investing.com. We used to use investing.com, but ever since then, we just started to use TradingView all the time. But there are many other charting platforms that you can use. Since we are not necessarily interested in fundamental analysis, so some other available tools, we may know them, but don't use them a lot. One of the tools is MoneyWeb. It's a website where you can find information about companies. We can also use shared data so that you can find stock exchange news services. But we digress. Now let us focus on why we are here. So January 2023 has been a good month for us. In fact, for everyone that is invested in the Johannesburg Securities Exchange. We saw that there was a recovery in the JSE Top 40 or the All Share Index in general. Some companies performed well, some companies didn't perform well. One of the companies that did not perform well is Thungela Resources. Some of the companies that performed well include Discovery, Naspers, and Prosus. So we do have some of those positions. So now when you look here, you can see this is where we are tracking our portfolio. We are using Google Sheets to track our portfolio. You can see that there are some trades, but the ones that are rating 10, those are the ones that we are going to share with you, because those are the ones that are normalized to 10,000 rand. The other ones, it shows the full amount that you are trading in our account. So again, Google Sheet is free. If you have a Gmail account, you can use a Google Sheet, but you can use anything to journal your trades. One reason why we prefer Google Sheet is because most of the time we're able to get the market prices just by putting in the correct tick. For example, in this case, we are looking here, there is a ticker of Naspers, and then we can see the current price if you use the Google Finance option there. So by default, Google Finance uses things in US dollars. So you need to put that JSE before the ticker name if you're looking for JSE stocks. And then because the prices are coming in cent, then you need to divide them by 100 so that they are shown in rands rather than in cents. So now if you look at the trades that we have at the moment, we have made around 18 transactions. We don't have 18 positions in our portfolio. It's just transactions. Most of these transactions are some of the positions that we carried over from 2022. So there are some positions that we took in 2023, but majority of the positions are positions that we carried over from last year. We know 2022 was tough market for everyone. Some people made money. Majority of people didn't make money in 2022, whether they were investing or trading the JSE or the US markets. So what we have here, we have the ticker because we need to know the name that we are trading. We have the entry price where we took the position. The date here is calculated. As you can see, there is a code for it, because these things, Google Sheet does some fancy iteration at the back. It's supposed to put in the correct date, but if you do not, or if you change some things, it can give an incorrect date. So we didn't start trading in 1899. And then we have the current share price, because we need to know for that particular position whether it is sitting in profit or it's not sitting in profit. And then the return on investment in terms of percentage, if we're in profit by how much, if we are sitting at a loss by how much, and the R is based on the risk that you are willing to take. So as soon as a position reaches a minus 1R, we're supposed to exit, but you can see there's minus 11 there from RMB. We are also part of the people that bought RMB shares when we wanted to receive the dividend. But after or on the ex-dividend date, the share price dropped by over 60%. And since then, we've been sitting at a negative 71%. So things are not always great in the investing arena, but it is what it is. So we have a stop loss, we have a take profit. If ever we take a trade, that is going to have a take profit and exit price. And then we have a final profit and loss. And then we have a dynamic. The dynamic is based on the share price, because the share price, it keeps on changing. Once we close a position, we put in the exit price. Then the final P&L is calculated based on the exit price when we exited the position. So like we said, we're trading 10,000 rand that we're trading, and then the amount invested capital is the amount that is invested in that particular company. We are not putting a fixed value on any company. The value that we put will be determined by the risk that we are taking on that particular company. But for all the companies, we are taking no more than a 2% risk. So some of the old positions, because we were in a bear market globally, at least last year, so the risk was below 1%, but now we are tuning back to our standard 2% risk. Remember, the risk amount, it's not just a number that you pick from the sky. It's an amount that you need to be comfortable with, because in the market, there will be losing positions, and whenever you are experiencing a drawdown, you need to be able to survive that drawdown. You don't want to just burn and crash at once. So in this case, if you say we're using 2% risk, since we're investing 10,000 or the total portfolio value is 10,000 rand, our risk is 200 rand, because that is 2% of 10,000 rand. That is the amount of money that you are willing to lose per position, not the amount of money that we invest per position. We can invest, as you can see, in some companies we have over 1,400 or so. So we can invest more than 200 rand, but the risk that you are taking is fixed at 200 rand. Okay. And we have the exit date. For some of the positions, we exited them recently. We didn't exit the position today, we just updated, but that is why it is writing today's date. Then we have a couple of trades that we took here. You can see the kinds of trade we do have. Swing trades. Basically, a swing trade is when we predetermine where we want to exit a position for profit. Remember, I said we're looking for asymmetric risk to reward. So if you're risking 10 rand, and then you say, okay, in this position, we want to make 30 rands because we are risking 10 rands. Or let us just use the 2%. If you are risking 200 rand, and then we say we want to make 600 rand in this position. So it means that we have, before we take a position, we have a risk to reward of 1:3. Once that target is reached, then we exit. That is why some of the positions are classified as swing trading. Normally, we will take a swing trade if we already have a big position, but we just see that the market is moving in our favor and we want to increase the amount of shares that we are holding in that particular company. Most of our positions, they don't have a take profit level, because we just want to ride the move. As long as the move is there, we just want to continue riding that move. And then the number of shares, remember that this is normalized to 10,000 rand. And also is equities, we can buy fractional shares. So the numbers is going to differ, but this is, remember, it's ratio based on our full account. But yes, we do agree that some of the positions are small. You can see that this position, let me check what this is. Okay, this is a process. You can see there it shows that you are holding a 0.48 of a share. But remember, the share price of process is at this moment, it is 1,208 rand per share. So yes, it will happen that you have a fraction of a share. It's not always that you're going to have a full share that you have in your portfolio. So some of the positions that we traded in 2023, we took this swing position on process. Yesterday we bought MTN shares. We reduced our position on Woolworths. Last week Friday we took a position on Sasol. And I think we bought Sibanye Stillwater. Okay, we bought Sibanye last year. We didn't buy it this year. So the position that we took this year was Process, MTN, Sasol, Woolworths. We just simply reduced the position. At the moment, Discovery, it's our largest position, because initially we bought Discovery there. We bought a couple of shares as it started to move in our favor. We increased our position, but then we realized that now we had about 20% of our capital invested in Discovery, and we didn't have Sasol shares when it started to turn the way that triggered our buy. So now that forced us to reduce our position in Discovery. Fortunately, we exited just a bit above break even, so we did not lose money in terms of risk, since we lost money in transaction fees as we exited that position to take a position on Sasol. So at this moment, we are happy with that particular position. So like I said, at this moment, we have about 16 transactions, but that doesn't mean that we have a 16 position. You can see Discovery there. It's there in triple, not duplicate. Same as Woolworths. Woolworths is there in duplicate. Naspers is also there in duplicate, because we took the first initial position, and then we sold half of Naspers. I don't remember what it is that we did with that money, but we sold half of Naspers. So that is why we have Naspers in duplicate in there. Remember, we are traders. Yes, we invested our money in the stock market, but we are not using investing in the stock market. So we will be going in and out of positions. That has its own implications. It could be tax because we don't hold the position for more than 3 years according to SARS. Whenever we see an opportunity, we grab that opportunity. Once the opportunity no longer exists, then we exit that position. We don't wait for 3 years. We don't wait for dividends. In January, we did not receive any dividend from all these positions. The only place where we received distributions was the Signia S&P 500 ETF. That is the only place where we got some money in a form of distributions, but we did not receive a dividend in this portfolio. So I mentioned that we already closed a couple of positions. So we closed 3. We took a half profit on Naspers. We closed a position on Discovery because we wanted to take a position on Sasol. Then yesterday we took a partial profit on Woolworths, because as the share price go up, it also, remember, when we open a position, we are taking a risk, because if the market move against us, we can lose that money. But once our position are in profit, now the risk that we are having is that we can give back the profit to the market. We also don't want that. We don't want to lose our principal when we take the position at the beginning. We also don't want to lose our paper profit, because if we lose our paper profit, let's say we exit and break even, we did not make money besides transaction fees, but at the same time we will have lost time in that position. So it is important that from time to time we also take bits and pieces of the profit or the paper profit that we are making, because when we close that position, then that profit becomes a real profit. It is no longer a paper profit, and we can use that profit to take a position in another company, and that also helps us to grow our equity curve. So now when you look at Naspers, we bought Naspers somewhere around 2,570 Rand per share. We exited at about 3,360 Rand per share. So that was a 30% move with the risk to reward of 1:5. We almost got a risk to reward of 1:6. And then now when we do the calculations there, we see there's the money, the actual amount that we made based on 10,000 Rand. Discovery, we didn't make money. It was just a half of R. It was just above a break even. I think this was sufficient to cover the transaction cost. So overall, we didn't lose money in there. And then for Woolworths, we exited for about 14% there, and we made a bit of money. Right, the thing that I want you to focus on, it's not the rand value that we made, because this can easily be misleading. We want you to focus on the percentage of return of investment and the R. Remember, I said we are looking at asymmetric risk to reward. So the reward has to be multiple times higher than the risk. So you can see for Woolworths and Naspers, we took a profit that is 5 times larger than the risk amount that we took. But if you look at the return on investment there, it is less than 50%. So we are not getting multi-baggers, and that is not a problem for us, because if you look back at the trade, for example, here we see, I just want looking for a value that is closer to minus R or plus R. You can see here with Investec PLC, we are at a 0.83 R. So it means that once we reach a 1 R, maybe that would be somewhere around 10%. So that means that the risk that we are taking on this position is 10%. So since we entered at 104 Rand 68 cents, it means that our stop loss is just somewhere around 95 Rand or so, but that is 10% less of this 105 that we took the position in. So it doesn't matter how much percentage we are returning. What matters is that how much of the risk we are taking in that particular position. You can see here we have a position on Discovery that is on close to 2R, but it is just about 11.64%. So once it reaches 2, probably it's going to be about 12%. So that means that we are taking a 6% risk on this particular position. The risk is always going to be determined by the volatility of that company. If a company, the price swings are up and down, then the stop loss is going to be wide, and that means that you are taking less position. But if the price action is tight, there is less volatility, then we can buy plenty of shares in that particular company without taking a lot of risk. The risk amount is fixed at 2%. It does not change. What changes is the number of shares that we are buying, and the number of shares that we are buying is determined by the price difference between the entry price and the exit price. So at this moment, you can see out of all these 16 positions, 4 of them are in red, including that RMH. We're not going to make an excuse for RMH, but you can see that 4 of our positions are in red. Other than RMH, other ones are still below -1. Once they reach a -1, we close those positions, because it means that our risk level has been hit. So now when you look at here over the closed position, you can see the average gain. So since we had 30%, 3%, 14%, our average gain is around 16% at the moment. We don't have an average loss yet, because at this moment there's no position that is closed for a loss. But that should not mislead you. It doesn't mean that we have 100% hit rate. In 2021, I think we had just around a 50% hit rate. So we know that losses are coming, and when they come, things are not going to be nice. So as we take more trades and record more trades, the number, they're going to start to reflect reality. So at this moment, it seems like, well, we are invincible because we don't have a loss yet. We know that the losses are coming, and we are comfortable with that. So when we look at the expectancy, basically the expectancy, we just need to know before we trade if do we have an edge in the market. Then an edge is something that we describe as what are the chances that you are going to make money versus the chances of us losing money. So we want the expectancy number to be positive. If it's negative, it means that we know for sure we are going to lose money in the stock market. So we calculated the expectancy by summing up the R's that we got. So in this case, we've got everything is green at the moment, and then we divided it by the number of trades that we have taken so far. So now we have an expectancy of 4. So it means that for every 200 Rand we risk, we're expecting to make at least 800 Rand from that particular position. But as long as we take a partial partial profit there, then this is going to start at some point, it will start messing up this. But we just want to see that we have a positive expectancy, so that whenever we take a position, we are confident. We don't need to be confident, like have self-confidence before we take a trade. We need to be confident that we have the skill to trade the stock market. Also, the approach that we are using, it is profitable as well, because the success in the market is not just going to come from you having a positive expectancy. Positive expectancy is a result of you as a trader having the skill to execute the trades and the discipline to take the trades and to sit when there's nothing that needs to be done, but also to use an approach that is profitable. If, for example, you log into social media, you get 10 people, you ask them for which stocks you're supposed to buy, and then you buy those stocks. You don't have skill, you probably don't have a discipline, and most importantly, you don't have a system that is quantifiable, that you can look back and say, okay, where did I make a mistake? Everything, all those kinds of things. So this expectancy is not just a number that can boost your ego. It's a number that is based on a combination of many things, including the discipline to execute your strategy. And then finally, because we've already closed a couple of positions, so at this moment, the equity curve is growing slightly, nothing fancy from 10,000 at the beginning. So we've closed 3 trades for a bit of profit. So the balance has increased to 10,200 Rand. So that is just around 2%. So that is how much the portfolio grew based on the trades that we have closed. We mentioned that January was good. So our overall portfolio is still up by around 10% since the beginning of the year. But this is the positions that we have closed, because at the end, when we give you the final result, it is going to be based on the positions that are closed, not on positions that are open. Okay, so we are happy with this 2%. It's not a lot, but we have to start somewhere. And also we are recording our risk to reward for the positions that we have closed. We mentioned that 2 of them, they averaged around 1:5 in terms of risk to reward. So we want to note as we make trades, are we getting more reward or we're taking too much risk? Then we can start to reduce the risk that we are taking. And then lastly, we can also visualize the return on investment for the positions that we've taken. So at this moment, we know that here we got around 3.28% on that discovery trade. And then the second trade is about 14.34%. And the highest return so far is 30.62%. So as long as we can manage to keep our return on return on investment above, well, we're not targeting any number. We're not going to say we want to make them to be above 10, 20 or 30% because that will be determined by the market. And as time goes by, if indeed we're in a bull market, then we can start to see 100% plus returns in the market. If we took positions in those companies that can return more than 100% in the market, we might also start to see those companies trickling down in our portfolio. So yeah, in this balance, we just have this where we're tracking what is happening. And then finally, we have a tab where we record everything so that we can have a snapshot of what is happening in our portfolio. Here we have our average gain, which is calculated in the other sheet. Our average loss, I mentioned that at this moment we have enclosed a position for a loss. So our win rate is going to be reflected as 100%, but we know that at the end, it is not going to be 100% because we know that there are times where we are going to lose money. So we shouldn't fool ourselves and think that we are always going to make money. And the large gain in rand terms and the large loss. So at this moment, this is our largest loss. I mean, our larger gain. The Kelly formula, since we don't have anything in terms of the win-loss ratio, is not going to give us anything meaningful. But basically, the Kelly formula, it tells you what is the optimal position size that you can take. So if you have a positive expectancy, meaning that we are more likely to make money than to lose money in the stock market, then that Kelly formula is going to tell you that, okay, you can be comfortable to take this much of a position because you don't want to invest too little because you're not going to see decent returns. At the same time, you don't want to invest too much because that is an easy way of blowing up your account. So there is a sweet spot there. Usually it's about 70%, but as we get more and more information, then these things are going to start to make sense. So yeah, that is all that I wanted to share with you today. We're going to be giving you updates from time to time, depending on how the market is performing. This year, we are making a commitment that we are going to continue with 10,000 Rand stock trading challenge for the remainder of 2023. And we will try to give you at least 1 month or a monthly update on what is happening. I mentioned that all the positions that we took them based on technical analysis whenever we do. So far this year, we have managed, at least for 2 or 3 weeks, we have managed to give a weekly stock market update. So most of the companies that we traded so far are there on the weekly update. We are doing a weekly update on the JSE. We're also doing a weekly update on the New York Security Exchange. We also cover things such as crypto. We spoke about Bitcoin, Ethereum. We spoke about Brent crude. We spoke about S&P 500 and Nasdaq, because the approach that we're using, we can trade a lot of things, but for the 10,000 trading challenge, that one is just fixed on the JSE, because we understand that not everyone, at least in South Africa, is going to be able to trade the JSE, the New York Security Exchange, the Australian market, the European market. Yes, I know those markets are available on your Easy Equities accounts or any other brokers that you are using. But just because they are there, it doesn't mean that everybody is using them. They are just available to anyone who wants to use them. But for those who can't afford to use them yet, it's not a train smash. So that's it for today. I will see you on the next video. Once again, those who haven't subscribed, please consider subscribing. And if you found value in this video, please make sure that you smash that like button. If you have any comment or suggestions or questions, please leave them in the comment section. We will see you in the next video.